Now we're very much at the end of this chapter, where we're talking about the basic standard setting environment. So with accounting, by and large, it was a self-governed profession for a very, very long time. There's been a lot of history in how we've gotten to where we've gotten. But as a whole, the accounting profession recognizes that there needs to be a set of rules and practices that have substantial authoritative support for us to recognize as our general guide for financial setting purposes. There are 4 various standard setting bodies that can be encountered generically across the profession. It's important that there be a way when there is some indecision for how a company to decide the type of financial information to disclose. What the format needs to be, that way users are looking at the same thing from one company to another, and how those measurements for things like assets, liabilities, revenues, and expenses are calculated. Those 4 entities are the SEC, which is a U.S. government agency that oversees U.S. financial markets and accounting standard setting bodies. There is the primary accounting standard setting body in the U.S., which is the Financial Accounting Standards Board, called FASB. Internationally, there's the International Accounting Standards Board, who set their standards, which are called the International Financial Reporting Standards. Those are subscribed to by over 115 countries. There is a commitment on behalf of FASB and the IASB to work on bringing the areas where we differ into convergence. You'll notice that there's information about the IFRS and FASB throughout your texts and the PowerPoint slides. Know that there are differences if we're dealing with a country in the U.S., a company in the U.S., then FASB is what we need to look at. That is also what we teach based off of. And finally, there's what we call Peekaboo. That's the Public Company Accounting Oversight Board. And they determine the auditing standards and they review the performance of auditing firms, which is really very important when you think about the necessity of clear, transparent, and accurate financial information that adheres to the standards that we have here in the United States. So here's just a really quick review question asking you what the generally accepted accounting principles are. We just talked about that. Are they a set of standards and rules that are recognized as a general guide for financial reporting? Are they established by the Internal Revenue Service? Are they the guidelines used to resolve ethical dilemmas? Are they the fundamental truths that can be derived from the laws of nature? So hopefully you agree that they are a set of standards and rules that are recognized as a general guide for financial reporting. So the reason why we have these general guides and the reasons why we do these things, one is for comparability, but more importantly, we're going to get down to talking about how do we provide the right type of information and what kind of information do we need to provide. So the information that is provided for decision makers, be they investors, creditors, or lenders, needs to be useful, and it needs to have 2 basic qualities to it. The first is relevance. The other is faithful representation. So starting with relevance, the question is information has the ability to make a difference in a decision scenario. If information can make a difference in the making of a business decision, it's considered relevant. If it provides information that has a predictive value, that is, helps provide some accurate expectations about the future. If it has what's called confirmatory value, it confirms or corrects prior expectations. And if it's material, so this is when its size is likely to influence the decision of an investor or a creditor. With this, materiality is not something that we can say, okay, anything over $10 is material, anything over $15 is material. This is very company specific. So for a very small company, something with a value of $100 might have a material aspect to it. Whereas for a company in the Fortune 500s, $100 really may not be a material decision-making issue. So let's think about relevance. When you go to a classroom, so you're going to campus and trying to decide what to wear to class. Did it matter whether you were going to English class or accounting class in making that decision? No, really, it doesn't matter which type of class you go to. You'll probably wear the same thing. But let's just take one more step. When you were making that decision, was it negative 10 degrees outside or was it 75 degrees outside? That did make a difference in your decision, right? So the temperature is a relevant factor. The class itself was not. Materiality is an aspect that allows firms to modify GAAP within reason. So let's think about materiality a little bit more. A firm decides to buy a new electric pencil sharpener, and it's expected to last for 6 years. It has a cost of $18. So GAAP says that a pencil sharpener, because it is expected to last for 6 years, should be listed as an asset in plant, property, and equipment and depreciated or charged or costed off over the 6 years it's expected to last at a rate of $3 per year. What the materiality constraint does is it allows us to expense that pencil sharpener immediately, because an $18 expense is not going to make a difference to the users of the financial statements. Materiality gives us a little bit of wiggle room in how and what we do. Now, the second quality, faithful representation, says that useful information is going to accurately depict what really happened. To provide a faithful representation, your information needs to be complete, meaning that nothing important has been omitted. It needs to be neutral, meaning that there is no bias towards one position or another. And it should be free from error. Financial statements must present faithful representation to be of any value. The SEC requires firms listed on an organized exchange to have financial statements that are audited by CPAs or certified public accountants. What the audit does is that it ensures faithful representation. It provides a judgment on whether the financial statements are showing faithful representation. This audit, this independent audit, and the opinion of the auditor provides the public the ability to feel a little bit more comfortable about the information that is contained in the financial statements that they are looking at. FASB and our standard setting bodies have also added some more definitions and qualifications to our information. So some enhancing qualities are comparability. Comparability results when different companies use the same accounting principles. To make a comparison, companies have to disclose the accounting methods that they use. Because things such as, and we'll get into these later, last in, first out, or first in, first out, can have a dramatic impact on how things report. Consistency. This is when a company uses the same accounting principles and methods from year to year. There is a requirement that you use those same principles and methods from year to year. However, you are not tied down to one forever or in all things. There are some caveats that do allow change, but when that change occurs, it has to be disclosed. Verifiability. This means that the information is verifiable if independent observers, so somebody else using the same methods, come up with the same results. Therefore, the information is proven to be free from error. This is part of the auditing process, is looking at the verifiability. In order to be relevant and be used to make current business decisions, accounting information has to be timely. It has to be available before it loses its capacity to influence decisions in one way or another. And lastly, accounting information needs to be understandable. It needs to be presented in a clear and concise fashion so that users can interpret it and comprehend its meaning. With all these qualities that are necessary for information to be useful, this is why we follow some basic assumptions, some basic concepts, why GAAP has defined the format and basis of the financial statements. Firms have to follow the prescribed accounting principles if users are to compare financial statements. If everybody did what they want, then there would be no ability to compare. If there's justification to change from one principle to the other, then that can be explained in the notes to the financial statements, and the company can make that change. The explanation lets the users know what has happened to make that difference. So therefore, while there is a need for consistency, using the same principles and methods from year to year, if there's a justifiable need to change it, the company is allowed to do that. So we're going to look at some of the assumptions and the principles in financial reporting. To develop the accounting standards, FASB relies on some key assumptions and principles. The first is the monetary unit assumption. This states that only transactions expressed in money are included in the accounting records. An example of a transaction that's expressed in terms of money would be an actual purchase of a building, the paying of rent for the month, the paying of payroll. Other things that occur in business, but that are not transactions that can be expressed in terms of money. Just hiring an employee. They haven't worked. There's no wage associated with them. There's no other costs associated with them yet. Just hiring them. Ordering a product. Although you've ordered it, you have no legal obligation to pay for it yet. Making a bid on a prospective job. So you are a construction company and you want to bid on the building in an apartment complex, so you send in that bid. Well, that may eventually result in an economic monetary unit transaction. Just submitting the bid does not. There's the economic entity assumption. This says that every economic entity can be separately identified and accounted for. Periodicity. This is the assumption that allows a business to be divided into artificial time periods that are useful for reporting. So months, quarters, years. There's the going concern assumption that assumes that businesses are going to remain in operation for the foreseeable future. Now, the going concern assumption is actually one of those that's a little contentious in the world of the CPA. And that is because an auditor actually does have to look for support of the going concern assumption. If they have a concern, they must report that. There are a few key principles that also come back to financial reporting. The first measurement principle. GAAP generally uses one of two measurement principles. There's the cost or historical cost, depending upon where you're reading it. But what that states is that companies record their assets on their books at the amount that they cost. The reason for that is because this amount is verifiable. There is something that actually holds up to it. Now, over time, the value of that asset may change. Therefore, the amount on the balance sheet and the actual value in the world may not coincide. The other measurement principle is fair value, which says that assets and liabilities should be reported at fair value. This is the price that would be received to sell an asset or settle a liability currently. When you're doing things in accounting, understand that currently historical cost rules most of the situations. There are a few caveats where fair value comes into play, and you will learn about those particular ones when they are on the table. But, for example, let's say you bought a van for your business. Now, the sticker price of that van at the dealership is $18,000. You have a neighbor who purchased an identical van just a week ago for $16,500. Now, you only actually ended up paying, after you went into negotiations and dickering with the car salesman, $15,000 for the van. Well, now we have a whole bunch of different values here, right? There's $18,000 sticker, neighbor paid $16,500, you actually paid $15,000. Well, there's three different values associated with a particular asset. With verifiability, we can say $15,000 of consideration. So that is the price at which the van should be recorded. Another key and very important principle is the full disclosure principle. So this is a principle that requires that circumstances and events that would make a difference to financial statement users have to be disclosed. Now remember, if they have to make a difference means they would need to impact decision making. They would have materiality. And last but not least is what we call the cost constraint. So the cost constraint is accounting standard setters weigh what the cost is that companies will incur to provide specific information against the benefit that that information will gain, the users will gain from having it available. So this is why we get summary data because it would just cost too much to provide line by line detail. There's not as much benefit to the users to have a line by line detail. Or there's a huge cost to the company to provide that in potentially having something proprietary that might leak to a competing organization. This brings us to the end of this particular chapter. Keep in mind that financial statement information, the financial statements, are the conveying of the accounting information system. They are the communication of the economic events of the organization over a period of time or at a point in time. And that information is useful in more than just accounting. It's useful for somebody to decide whether or not to lend money, to see if changes that we made operationally are yielding the results that we expect. A lot of people feel that accounting is nothing that they need to really understand. However, a basic familiarity and rudimentary skill in accounting really goes a long way. It's one of those skills that businesses across all industries are looking for in their new hires and in their college graduates they're hiring coming in.